This video is an introduction to income tax. If you're new to these videos, then please consider subscribing to the channel. You'll be very welcome. And if you press the like button, it really helps me. So income tax. What is income tax? Income tax is a tax on your income. So perhaps another interesting question is, what is income as defined for income tax? Well, there can be lots of different sources. Probably the most common source of income that most people have and most people are familiar with is what they earn from their employer in wages and salaries. And although they are taxed as income taxed, as long as they're above the thresholds, most people are taxed as income tax through their wages and salaries. They don't have to actually pay the tax, because it is all administered by their employer. There's something called PAYE, or pay as you earn. You pay the tax as you earn it. And all of that is administered by your employer. So as an employee, yes, you're taxed, but you never see it. You just see the entries on your payslip and you get the bottom right-hand corner. So moving on from income tax, another source of income that a lot of people have is rent. So rent is the money you get for letting somebody reside or use your property. And the taxable income for rent is the income, the rent you receive from your tenants, less the costs wholly and exclusively for that rental business. So in a rental, normally you'll have the rental income less interest. You might have some gas certificate costs, you might have some insurance costs, you might have your own personal cost administering it. All of those costs are taken off, and the profit that you then end up with, that is what's subject to income tax. So the next thing that I want to have a look at is interest. Now, back in the day, interest was a major source of income. With interest rates very, very low at the moment, interest is no longer an important source of income for most people, but it is another source of income and can be taxed. Now, I'm saying it can be taxed because the first £1,000 of interest is not subject to tax for basic rate taxpayers. And because of that, very few people earn more than £1,000 in interest. So therefore it is taxable normally, but normally you don't actually pay any tax because you're below the threshold. But interest, and maybe, who knows, interest rates may go up. And if they do, more people will pay this tax. So then you also may receive dividends. So what is a dividend? A dividend is in relation to a company. So if you own shares in a company and the company makes a profit, then it might let the shareholders have some of that profit. So when the company shares its profits with its shareholders, that comes in the form of a dividend. So that's what a dividend is. And that dividend is taxed as dividend tax, which is a form of income tax. So again, it's another source of income and it's taxed as income tax, but it's actually called dividend tax, and it's actually at lower rates than the main income tax rates because the company has already paid tax on it. So perhaps the more familiar form of income that people might have is from a trade or a partnership. So if you've got a trade, so if you're literally a tradesman, a plumber, a joiner or something like that, you may not want to go through a limited company, so you have a sole trade. So you, as a sole individual, trade, which means you make sales and then you have costs of those sales. So in a typical plumbing business, you'll have the sales that you make, and then you'll have the costs of the materials that you buy. The copper pipes, the boilers, and then your van, employing an accountant maybe. Insurance, all those sorts of things. So if you take all your costs, take that off your sales, that'll give you your profit, and that profit is subject to income tax. And it's not just your UK income that you'll be taxed on. So if you are a UK, been in the UK all your life, you're a UK citizen, all the rest of it, you will be taxed on your worldwide income. So it doesn't matter where in the world you receive income, you are taxed on it in the UK. And how is this administered? So it's administered through your tax return. So if you have income that hasn't previously been taxed, like PAYE that I talked about, so if you've got other income where you are going to owe the revenue money, it's all taxed, and it's taxed under self-assessment. And self-assessment, again, it means what it says on the packet. It's you yourself assess what tax you have to pay, and then you pay it over. And the obligation is on the citizen to pay the tax, and not on the revenue to work out if you're hiding money away. Under self-assessment, it's for the citizen to work out how much tax they have to pay, and then to pay it over. It's not for the revenue to work out, where anybody's hiding the money and then tax it. So how much tax do you pay? Well, we have a progressive tax system, which means that the rate of tax increases the more income you have. So if you earn between 0 and 12,500, this is in the 2020-21 tax year, the lowest rate, less than 12,500, that's taxed at 0%, so you don't pay any tax. Between 12,500 and 50,000 pounds, it's taxed at 20%. Between 50 and 100,000 pounds, it's taxed at 40%. After 100,000 pounds, you get your personal allowance taken away. So although the tax rate is 40%, the effective tax rate, because you get your personal allowance taken away, is more than that, it's 60%. So between 100 and 125,000, you pay an effective rate of 60% tax. Drops down again to 40% after 125, to 150. After 150, you pay 45% tax on the rest of your income. Although that's a very high rate, it's a very large amount of income. So who taxes you? So it's the government that decides what taxes you should pay. So tax is law, so it's all tax law, so it's all legislated for in Parliament. And then the way that it works is there's a body called HMRC, Her Majesty's Revenue and Customs, and they administer it, collect it, work it all out, have a very helpful website, and do the dirty business of collecting the tax for the government. So HMRC is the agency through which income tax is collected and administered. And how does all that work? So the way that it works is that each year you fill in a tax return. If you've got tax to pay, you fill in a tax return. It's mostly done electronically. You file it electronically. It works out how much, the software works out how much tax you have to pay. You can check it, the accountants can check it, and on you go. So it's a once a year thing. And what is the year end? So the year end for income tax is always the 5th of April. So it's all your income that you earn in any year from the 6th of April through to the 5th of April. So I suppose, why is it the 5th of April? And I'm just going to let you know, because it's a peculiarity in the system. And I guess it's a good example of one of the many peculiarities that there are in the system, a system of taxation that has been created over hundreds and longer, many hundreds of years. So the 5th of April, to work it out, you've got to go back to AD 46. So in AD 46, there was a Roman emperor called Julius Caesar, and he worked out, or his team worked out, the Julian calendar. And the Julian calendar worked out that you needed to have leap years, that there weren't 365 days in a year, there were 365 and a quarter days in a year. But it's not quite right. So between AD 46 and AD 1582, there'd have been a bit of slippage. So we'd always had the year end as the 25th of March, which is also Lady Day. So the 25th of March was always the year end. But the slippage had meant that the 25th of March had actually become the 5th of April. So along came Pope Gregory, and he worked this all out, or his team did, and so they started the Gregorian calendar. And the Gregorian calendar rolled it back from the 5th of April to the 25th of March, and they also changed the year end from the 25th of March to the end of December. And then for 200 years, the British and other Protestant countries just ignored all of that because they actually considered that something that was issued by the Pope was the work of the devil. That's actually what they thought. And so, therefore, they would not adapt it. So if you were in the UK or Sweden, then we were on one calendar, and it was actually a different day in the year if you went to France or Spain or Italy or a Catholic country. There you go, it's madness. But anyway, so in 1752, we finally relented and went from the Julian calendar to the Gregorian calendar. And also in the process and in the mix, changed our year end from 25th of March to the end of December. So why do we have the 5th of April as our tax year end date? Because it is the year end under the old Julian calendar as it was converted to the Gregorian calendar in 1752, and it's just stuck like that ever since. And that is the basis, the most fundamental fact in our tax system, the tax year end date, and that is how convoluted it is. So you can imagine when you go through tax law just how weird and wonderful it is, and how sometimes it works as you expect, but sometimes it just doesn't. And that's, I think, a really clear illustration, a very human illustration of the peculiarities that we have in our system. So that's the basic guide to income tax. If you follow this and you want to see more similar basic guides to taxation, then please subscribe. Feel free to subscribe to the channel. You'll be very welcome. And if you press the like button, it really helps me. Thank you.